Somewhere this week, a silver investor opened their phone before sunrise, saw a sharp red number next to the metal they had trusted for years, and felt their stomach drop. That single moment, that quiet gut punch before the coffee is even made, is happening in homes across America right now. Silver just took a hard hit. But while most people were reacting to the headline, something quieter was happening underneath it, inside the COMEX futures market, and that quieter story may matter more than the drop itself. Today we are going to walk through exactly what that signal is, why it tends to show up before major turning points, and why so many everyday investors miss it completely because they are too busy watching the price and not watching the structure underneath the price. Before we go further, if you find this kind of grounded, no-hype market breakdown useful, take a second to like this video and subscribe to Smart OG John AG. It genuinely helps more people find thoughtful, educational content like this, instead of the fear-based noise that usually fills up financial media, and it costs you nothing but a click. Here is the situation. Silver dropped, and dropped hard enough that it made people uncomfortable. Some investors who had been holding for months suddenly questioned everything. Should they sell? Should they average down? Did they miss their window entirely? That emotional whiplash is completely normal, and if you felt any version of it recently, you are not alone and you are not doing anything wrong. Markets are built to test conviction, and silver in particular has a long history of testing patience before rewarding it. But here's what most investors never realize. A price drop on the surface and a structural shift underneath the surface are two very different things, and they do not always move together. On the COMEX, which is the main exchange where silver futures contracts are traded, there is a layer of activity that never makes it into the evening news. It involves how many contracts are open, how positioning is shifting between large institutional players and smaller speculative traders, and how physical delivery demand is behaving compared to paper contract volume. When silver prices fall sharply, while this underlying positioning starts shifting in the opposite direction, that divergence is historically one of the signals experienced traders watch most closely. Let's slow down and explain that in plain language, because jargon helps no one. Think of the COMEX like a massive marketplace where people agree today on a price to buy or sell silver at some point in the future. Most of these agreements never involve anyone actually receiving physical silver. They are financial bets on where the price is headed. Now, most of the time, price and these bets move in the same direction. Price falls, bets lean bearish. Price rises, bets lean bullish. That is normal and expected. But every so often, the price falls, while a specific group of large traders quietly starts reducing their bearish bets or increasing their bullish ones. That mismatch is what some analysts refer to as a positioning divergence. And historically, sharp divergences like this have often preceded periods where the metal found a floor and reversed. Now, I want to be very clear here, because this channel is not in the business of making guarantees. This is not a prediction that silver will spike tomorrow. Nobody, no analyst, no chart, no indicator can promise that with certainty. What we can say is that historically, when this kind of positioning shift has appeared alongside a sharp price drop, it has often been followed by periods of stabilization or upward movement in the months that followed. Past patterns are not promises. They are simply patterns, and understanding them helps you think more clearly instead of reacting emotionally. There's another reason the market may be reacting this way, and it goes beyond silver itself. The US dollar plays a massive role in how precious metals behave. When the dollar strengthens, silver and gold priced in dollars often become more expensive for buyers using other currencies, which can reduce demand and pressure prices lower. When the dollar weakens, the opposite tends to happen. Right now, dollar strength has been a major storyline, driven largely by expectations around Federal Reserve policy. When the market believes interest rates will stay higher for longer, The dollar tends to attract more global capital because higher rates mean better returns on dollar-denominated assets. That pulls money away from metals, which pay no interest at all, and toward interest-bearing instruments instead. This is where things become really interesting. The Federal Reserve does not just influence markets through actual rate decisions. It influences markets through expectations, through language, through subtle shifts in tone during speeches and meeting minutes. Traders are constantly trying to predict what the Fed will do months from now, and those predictions move markets today, long before any actual policy change occurs. So when silver drops sharply, it is often not really about silver at all. It is about shifting expectations for interest rates, inflation, and the dollar, all colliding at once, with silver simply being the asset that reflects that collision most visibly. Let's bring this back to something relatable. Picture a retiree in Ohio who bought silver a few years ago specifically to protect her retirement savings from inflation eating away at her purchasing power. She is not a day trader. She does not watch COMEX positioning data every morning. She just sees the number drop and feels a wave of doubt about a decision she made for very sound reasons. Understanding what we just walked through, the difference between short-term price noise driven by dollar strength and Fed expectations versus the actual long-term case for owning silver can be the difference between panic selling at the worst possible moment and simply holding steady because you understand why the price moved. Most headlines focus on one story, the drop itself, while the real signal may be somewhere else entirely, buried in positioning data most people never look at. The market often rewards those who understand this difference, not because they can predict the future perfectly, but because they are less likely to make emotional decisions based on incomplete information. Now, let's talk about gold for a moment, because silver rarely moves in isolation. Gold and silver are often called sister metals, and while they do not always move in perfect lockstep, they are influenced by many of the same forces: inflation expectations, dollar strength, real interest rates, and overall investor sentiment toward safe haven assets. When gold holds up relatively well during a period where silver drops sharply, some analysts view that as another clue that the silver decline may be more about short-term positioning and liquidity than about a fundamental shift in the broader case for precious metals. Silver tends to be more volatile than gold in both directions, partly because the silver market is smaller, and partly because silver has significant industrial demand from electronics, solar panels, and various manufacturing uses, which adds another layer of price sensitivity tied to the broader economy. What happens next may surprise you. Historically, silver has shown a pattern of larger percentage moves than gold during both rallies and corrections. This is sometimes referred to informally as silver having a higher beta to gold, meaning it tends to amplify gold's moves. If gold experiences a modest pullback, silver has often experienced a sharper one. But the reverse has also historically been true. When gold and precious metals overall begin recovering, silver has often outperformed gold on the way back up. This is not a guarantee of what will happen this time, but it is a well-documented historical tendency that long-term precious metals investors often keep in mind. Later, we'll look at one market signal that many investors completely overlook, something tied to industrial demand rather than investment demand. But before we get there, let's talk about inflation, because this is where a lot of confusion happens. Inflation numbers came in a certain way, interest rate expectations shifted, and silver reacted. Many newer investors assume that inflation and silver prices should move together in a simple, predictable way. Higher inflation automatically meaning higher silver prices. Reality is more complicated. What actually matters most is not inflation in isolation, but real interest rates, meaning interest rates after subtracting inflation. When real interest rates are low or negative, precious metals have historically tended to perform better, because holding cash or bonds offers little to no real return after accounting for rising prices. When real interest rates rise, meaning interest rates are climbing faster than inflation, precious metals have historically faced more pressure because investors can earn a meaningful real return elsewhere. This is the part that changes everything for a lot of viewers watching this. If you have been confused about why silver sometimes falls even when inflation headlines look concerning, it is very often because the market is focused on real interest rates and Fed expectations rather than the raw inflation number itself. Understanding this one distinction alone puts you ahead of a huge portion of retail investors who are reacting to headlines without understanding the mechanism behind them. Now let's talk about that overlooked signal I mentioned earlier, the industrial demand side of silver. Unlike gold, which is used overwhelmingly for investment in jewelry, silver has substantial demand from solar panel manufacturing, electronics, electric vehicles, and various industrial applications. This means silver prices are influenced by two very different forces at once: investment demand driven by inflation and dollar expectations, and industrial demand driven by manufacturing activity and global economic growth. When these two forces pull in different directions, it can create confusing price action that frustrates investors trying to make sense of short-term moves. Many analysts believe that longer-term structural demand from the renewable energy sector represents a meaningful tailwind for silver over the coming years, though how quickly that demand materializes and how it interacts with short-term price swings remains something market participants are watching closely. Let's pause and talk about psychology for a moment, because this matters just as much as any chart or data point. Sharp price drops trigger something very primal in the human brain. It is the same fight or flight response that kept our ancestors alive around predators, except now it is triggered by a red number on a screen. This response pushes people toward quick decisions: sell now, get out, protect what is left, even when a slower, more researched approach would often serve them better. Historically, some of the worst long-term investment outcomes have come not from the initial drop itself, but from panic-driven decisions made during the drop, decisions that locked in losses right before conditions improved. This is not investment advice specific to you, and everyone's financial situation is different. But understanding your own emotional reaction to volatility is often just as important as understanding the market itself. Here's what most investors never realize about long-term precious metals investing specifically. Silver has historically gone through extended periods of sideways movement or decline, sometimes lasting months, occasionally longer, before experiencing sharp upward moves that happen relatively quickly. This pattern has frustrated many investors who expect steady, predictable growth. Silver simply does not move that way, historically. It tends to consolidate, test patience, shake out short-term traders, and then move in sudden bursts. If you understand this pattern going in, sudden drops become far less alarming because you recognize them as part of a historical rhythm rather than a sign that something has gone fundamentally wrong. But before we continue, let's talk about something practical, because education without application only goes so far. If you are someone holding silver or gold for long-term wealth preservation, some habits that many experienced investors have found useful include avoiding checking prices multiple times a day, since short-term volatility rarely reflects your actual long-term thesis. Many also find it useful to have a written reason for why they originally invested, so that during volatile periods, they can revisit that reasoning instead of making decisions based purely on emotion in the moment. Some investors also choose to average into positions over time rather than trying to time a single perfect entry point, since research suggests that consistently timing market bottoms is extremely difficult, even for professional traders. None of this is a guarantee of better outcomes, but these habits have historically helped many long-term investors stay disciplined during uncertain periods. There's another indicator that could change how you see today's market, and it involves paying attention not just to price, but to volume and how quickly a price move happens. Sharp drops that occur on unusually high volume in a short period of time, sometimes called capitulation moves, have historically been associated more often with short-term bottoms than with the beginning of extended declines. This happens because capitulation often represents weaker, more emotionally driven holders exiting all at once, which can clear out selling pressure and set the stage for stabilization. This is not something that can be predicted perfectly in real time, but it is one more piece of context that experienced investors often factor into their thinking rather than reacting to price alone. Let's bring together what we've covered so far. Silver dropped sharply, and that drop triggered real emotional reactions in real people across the country. Underneath that price action, COMEX positioning data has historically offered clues about whether a move reflects a genuine shift in sentiment or simply short-term repositioning among traders. The US dollar and Federal Reserve rate expectations play an enormous role in precious metals pricing, often more than the raw inflation headlines that dominate the news. Silver's dual identity as both an investment asset and an industrial metal adds complexity that gold does not experience in the same way. And historically, silver has moved in bursts rather than steady lines, testing patience before rewarding it. None of this means you should buy, sell, or hold anything specific. Every investment decision should be based on your own research, your own financial situation, your own risk tolerance, and ideally a conversation with a qualified financial professional who understands your complete picture. This channel exists to help you understand markets more clearly, not to tell you what to do with your money. Before we wrap up, I'm genuinely curious. What's your current outlook on silver after a move like this? Do you think today's reaction is justified by the fundamentals, or does it feel more like short-term noise driven by dollar strength and rate expectations? If you already own gold or silver, how are you personally approaching a pullback like this one? Are you holding steady, adding gradually, or reassessing entirely? Drop your thoughts in the comments, because this community has some genuinely thoughtful perspectives, and I read through as many of them as I can. If someone in your life, a parent, a sibling, a friend, has been asking questions about silver, gold, or protecting their savings during uncertain economic times, consider sending this video their way. Financial education spreads best when people share it with the people they care about, and clear thinking during volatile markets is something everyone can benefit from. Markets will always have moments like this one, sharp, uncomfortable, and full of conflicting headlines. What separates investors who build lasting wealth from those who get shaken out at the wrong moments is rarely luck. It is usually patience, understanding, and a willingness to look past the surface-level noise toward what is actually happening underneath. Stay patient, stay curious, keep learning, and keep making decisions based on your own research and your own long-term goals rather than short-term fear. Thank you for spending this time with Smart OG John AG, and I'll see you in the next one.